Corporate finance practice problem using Excel. Capital lease versus operating lease determination. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab in essence being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side, looking at some calculations that could help us to determine whether or not something needs to be recorded as an operating lease or a capital lease. Now, I'm not going to go into all the rules related to this because this is more of an accounting type of thing in terms of the regulations when we report this on our financial statements. Do we have to report it as a capital lease or an operating lease? But just a quick overview. If we have to record it as a capital lease, that would mean that typically, even though it's structured as a lease, we would have to record the asset if we purchase the asset on the books, and we would have to record basically a liability, which would be the equivalent of the lease payment obligations that we have for the capital lease. If it's an operating lease, then all we have to do is expense the lease payments as they come up. Now, why would this be an issue? Well, you can imagine situations where a company might then set up something to look like it's going to be a lease kind of agreement in form, but in actuality, it's actually a purchase. So that means that for regulatory standpoints, we would like to see it on the financial statements, right? We would like to know it as a purchase. So if you're locked into something, if you basically purchased it, then it would be best for the transparency to put it on the books as a purchase. So from a decision-making standpoint, then, when we're making decisions about what we're going to do, we probably also want to determine whether or not a lease is more of a purchase or a lease. And then, of course, we want to know what the impact of a capital lease or an operating lease might be on the financial statements. So what are the things? We won't go over the rules in a lot of detail here, and they could differ depending on the accounting standards that you have. But the general idea, so for generally accepted accounting principles, you might have the rules in terms of when you have to have something as a capital lease or an operating lease. But you can get the general idea. And notice how obviously the lines are going to be somewhat arbitrary because they're going to have to draw a line somewhere. But generally, the general idea, of course, would be, well, if you basically purchased the piece of equipment, even though it's in the form of a lease, then you should record it basically kind of more as a purchase, put it on the books as an asset and recorded the related liability. So that means that basically if we were to present value, for example, the required payments that you're going to be locked into basically, and they're equivalent to the property value that you could have purchased it for, it looks like it's kind of an actual purchase agreement there that has been basically financed as opposed to simply a lease type of agreement. Or if you've set up the lease agreement that you're going to basically lease it for the entire life of the property, for a substantial amount of the property. So if the lease, if the equipment that you're purchasing has a 5-year life that you expect it to be having a life for, and the lease is basically close to the entire 5 years and you're locked into that lease, well, it looks kind of like you purchased it because you leased it for the entire useful life of the property. So those are going to be the type of tests that you'd have to go through. So let's look at our data here and let's take a look at some of those tests we might do. The reason this is going to be appropriate here is because we have to use that present value type of calculation if we want to try to think about that question as to how much of the payment we made is close enough to the market value, because we have that timing difference. So we'd have to take that into consideration for that part of the test to determine if something is a capital lease or operating lease. So if we look at a lease and we're saying the months, we're saying there's a lease of basically an asset, let's say a fixed asset of 252 months, and the asset has a life of 26 years. So 26-year life, and we're going to be leasing it for 252 months. And then we have the minimum lease payment, so we're going to be paying $2,000 per month. And the discount rate that we're going to be using for this calculation is going to be the 11%, and the property market value is $201,000. So the thing could be purchased today for $201,000, but we have this lease that was being set up where we're going to basically make a payment of $2,000 for 252 months. So that's going to be the idea. So first calculation, let's take a look at the lease percentage period, meaning what's the comparison between how long we're going to lease this thing, or we've locked in to lease it, versus the life of the asset. That's one test that you could have in place. So, for example, if we say that the lease period is for in months, the 252 months, let's take a look at then how many months are in a year, which are 12. I'm going to underline that by going to the font group and underline, and that's going to give us our lease in years. So the lease in years then would be the 252 divided by 12. So we're looking 21 years. Now the life of the asset was 26 years, so we can then compare how long we've locked into leasing it versus the life of the asset. So we're going to go to the font group, underline it. So we're going to say this is the lease period percent. And that would be the 21 divided by 26. And let's make that a percent. Number group, percentify that. We'll add a couple decimals. So if we're leasing it for basically 21 years out of 26 years, we're locked in to lease it for like 80% of what we believe the useful life would be. So that's the first marker we might say is that, over the threshold to be required to record it as a capital lease. And then another question might be the present value of the lease payments. And this is where the present value calculation comes into play. So if we, for example, have the monthly payments, let's call it monthly payments are going to be the $2,000, and let's try to put this into a yearly basis. We can also do it with like a monthly basis calculation, but let's first convert that $2,000 into how much we're going to pay on an annual basis. So we're going to say, all right, so we have the months in a year are 12. So I'm going to make that 12 font group and underline it, and that's going to give us our yearly payments, which would be equal to the 2,000 times 12. So we have the 24,000. So we're going to be paying 24,000 it's going to be monthly, but we're going to break it down to a yearly calculation, 24,000, and we'd be making those 24,000 per year for the, 21 years. So if I present value that using our discount rate of the 21%, then how close is that to the actual value of the asset, which is 201,000? In other words, if I paid this 24,000 times the 21 years, then I would be paying far over the 201. But that's not really a fair calculation because that, we're not taking into consideration time value of money. So we got to discount the payment and see how close to what we're actually paying is equivalent, or how close it is to the purchase price of it, and to make this determination. So we're going to then take the present value of payments, which is going to be negative present value, shift 9. The rate is going to be the discount rate of the 11%. The number of periods we're going to say is 21 years, comma, and then the yearly payment is going to be that 24,000. And that's going to be our annuity. That gives us 193,803. And then we can compare how close that is to this 201. Now that's a bit of a simplified calculation there too, because you might say, well, why don't I just do the present value like on a monthly basis? Why did I need to make it a yearly type of calculation? And this might be determined on whatever kind of the generally accepted accounting rules might be more specific in terms of, or whatever rules you're using. You could have a different standard if you're on the world basis, but you might be more specific. But you might say, why don't I just use the monthly standard and then the discount rate? So we could do a similar calculation like that. It would be negative present value, shift 9. The rate would be the 11%. That would be for each per year. But now we want to take it down to a monthly rate. So I'm going to take that divided by 12. Now note, if I was to do that by hand, of course, that's going to get to a very small percent. But using Excel can take that percent and calculate it quite easily. So we'll take that divided by 12. That would be the monthly rate, which we're going to match out to the number of periods in months now, which is going to be this 252. So we got the 252 months, comma, and then the payment's going to be the monthly payment. So rather than the 24,000, we got the 2,000. And that'll give us a slightly different number because we took it on a monthly basis, but we get a similar calculation here. In any case, we can then compare that. We can now compare that to the actual price. So let's take the first one, present value of payments, and this is going to be the 193,802, and we're going to compare that to the market value of the property, meaning what we could purchase it for today. If we just threw down cash throwdown, it would just be 201,000. Underline that, and that's going to give us our, let's just call it the total. Comparing this out, the 193,802 divided by the 201 price, making that a percent number group, percentify it, couple decimals, so 96.42. So that's pretty close to the price. So you would think that you must capitalize, right? It looks like let's say must be a capital lease, right? Because it looks like this is more of a purchase. So you would think these would be over the threshold. We're purchasing it for a substantial amount of the life, but only 80%. But then we're also, if we present value what the actual payments were locked into, present value in it, we're on the 96% of what we think the current purchase price would be. So you would think that you might have to structure it then as a capital lease. What does that mean? You'd have to put it on the books as an asset and then record the related liabilities for the lease payment obligations for it in a similar way to a purchase situation, instead of just writing off the $2,000 on a monthly basis for the monthly expenses. And you can see how this gets kind of complicated, of course, because you know different incentives on how you're going to structure the leases then can get somewhat complicated, and what the obligations are under the lease can be somewhat complicated. So obviously, the more transparency, the better. On the financial statements, good, and then also in the footnotes to see what the company would be locked into when you're just talking reporting bases.